Everyone, good afternoon. Thank you all for joining us. Just as a quick introduction, my name's Danny and I am working in the marketing team at StuRents. Just while we're waiting for everyone to kind of join, I'll just go through a couple of housekeeping bits so we're all aware of what's coming up next. So to start, this webinar is held to coincide with the release of our weekly reports, which are due to be released in the next coming days. So keep an eye on your inboxes for that. The session will be recorded and will be shared with everyone on the call post the webinar. And as always, we're pleased to be joined by panel industry experts who will be sharing their views on the market, and we will continue the discussion at the end of the day's presentation with your questions. We've had a lot of questions come through, but if you do have any other questions, please drop them in the Q&A box, and we'll try to get to those at the end of the webinar. So on that note, I think we've got loads of joiners now. So I will just give a quick intro to Alex. So over to you, Alex, just to give us a quick introduction of who you are.
Thanks, Danielle, and hi, everybody. My name is Alex Katz-Nelson. I work for a company called Landmark Properties, which is a vertically integrated student housing developer that was based in the US and recently expanded into Europe. For the last 6 years, I guess, before joining Landmark, I worked for a company called Harrison Street, where I was focused primarily on UK BTR and PBSA investment. So long time in the industry, and then just recently moved to London to help lead up the Landmark team.
Great, thanks, Alex. We'll get back to you in a bit. I think before I hand over to Rich, so he can do his data presentation, we just have a number of poll questions that we'll put on your screen, which you should see now. So if you are happy to answer, what are your rental growth expectations for 2025 to 2026? Next question, what are your expectations for the international demand for 2025-2026 compared to last year? And the last question is, how has your overall view towards the student accommodation market shifted over the last 3 months? Feel free to just put your answers, and then you can always just close the poll once you've answered your questions. Great. So on that note, I am going to hand over to Rich, who will take us through today's data.
Thanks, Danny. So as always, we've got quite a lot to get through, kind of about 15 minutes, roughly speaking. Before we do that, by way of a quick introduction for anyone not familiar with what we do as a business, so very quickly, I guess to break us into 3 distinct parts, we have the listings platform, so StuRents.com. That's been going since 2008, and we list, roughly speaking, about 750,000 beds nationwide. We are also a leading provider of property management software to the sector, and that's via our separate brand called Concurrent. And to date, we've executed about 3.1 billion in tenancy value. And essentially, we can use those 2 platforms, supplement the data where we need to with outside sources to provide really granular, truly independent data to a real wide range of stakeholders within the sector. In terms of what I'll be covering today, so we're going to have a look at, I guess, the headline fundamentals within the sector and how that's changed more recently, particularly in light with the latest data from HESA. We'll then look at how that's playing out in terms of PBSA leasing velocity. And then we'll touch on some similar themes that we usually do on these webinars. So we'll look at how student search behaviour has changed over the last 3 months. And we'll touch on some of the latest planning updates as well. And then, as Danny said, we'll hand over to Alex, and then we'll have a bit of time towards the end for Q&A. So as mentioned, today we wanted to start today's sessions really looking at how the market has shifted over the last 12 months and specifically focusing on supply and demand. Now, when we do that, we want to take a look back at what we were previously reporting or showing in these sessions. For anyone not familiar with the chart on the right-hand side, this is typically how we look at supply and demand. So this is nationally, and it's excluding London. But what the lines represent are the cumulative change in supply, which is the orange line, and the cumulative change in demand, which is the blue line. And we have a few different growth scenarios there from a demand perspective, which is why we see three different lines. But what we can see nationally speaking, again outside of London, is that particularly kind of during that COVID period, there was a significant amount of demand growth, and that really wasn't being matched by supply growth, which again is the orange line in this example. So it looked like fundamentals were broadly very, very positive, and that looked like it was going to be maintained. However, that was relying on continued very significant demand growth, which again we saw during the COVID period. With hindsight, and obviously hindsight is kind of 2020, but on reflection, it was unlikely those levels of demand growth were going to be maintained. And let's kind of look at that and see how that has played out from a fundamental standpoint. So this is the kind of picture before the latest HESA release, and now we can look at it after. And what we can see is that actually, particularly for 2023, which again is the latest data available from HESA, we actually saw a slight dip in demand. So what it means is those fundamentals, whilst they are still broadly positive from a national standpoint, and that's because we're seeing those blue lines again tracking above the orange line, which is supply growth, it's probably less positive than we were a couple of years ago, again coming out of COVID. Now, one of the challenges around particularly predicting demand growth, particularly in recent years, is the volatility in demand, specifically around postgrad recruitment, and we'll come back to that shortly. But if we look at the chart now on the right-hand side, and we take, for example, the lowest line from a demand growth perspective, and that's assuming 2% growth, if demand was to grow by around 2%, then actually that gap between demand growth and supply growth is roughly tracking and roughly staying broadly in line. What it does show, though, is how future demand growth naturally is going to significantly impact the output and the outlook for the market. So if we take the middle line, which is the grey dotted line in this case of 3% growth, which is not massive, you can see that spread actually increases slightly. So really looking forward, it's very much going to depend on, again, future demand growth, and that's going to impact the kind of headline supply and demand fundamentals. Naturally, as always, we'll caveat this. This is looking at it from a national perspective, but there are significant variations per city, which again, we've explored numerous times in our previous sessions. Moving on to, I guess, some of the more recent data. So we did mention this in the quarters webinar last time round, but we wanted to dive into a bit more detail, is looking at the data from the Office of Students. So again, from the conversations we've had, there still seems to be a lack of awareness around this data. It has increased, but there are still plenty that aren't maybe familiar with it. The reason why we find it particularly useful is it's more up to date than HESA. So the OFS data actually covers the 2024 period. So again, more up to date than HESA. However, there are caveats. So it only covers England, for example. It also doesn't provide the country level splits. So we can't ascertain whether it's Chinese growth, for example, or Indian growth. And it's what they technically classify as early estimate data. But what we can see from the chart on the right-hand side is that OFS bar is highly correlated to the HESA data. So whilst the numbers are not exactly the same, the trend does very much seem to, again, be correlated. So what we can see again here is that huge growth, particularly coming out of COVID. Now, the OFS data actually shows a slight dip in overseas students, and that's what this particular chart is looking at. And that's down about 7.5% year on year in 2024. Now, whether that's Chinese students, Indian students, Nigerian students, we don't know for sure until we get more data, but we would probably expect it to be a combination of those. More positively, home fee, so domestic students were actually up still by 0.8%, which is positive. But due to that international decline, overall numbers were down by about 1.4% year on year in 2024. So we'll see how that plays out from HESA data, but it gives us a slightly more up-to-date view of demand trends. Looking at a number of locations next, and just kind of picked out a handful here. I mentioned a few moments ago that recruitment volatility was making the market harder to predict, particularly in recent years, and that's very much apparent from this data. So if we let's take Sheffield, for example, which is the navy line in this chart here, we can see that actually between 2018 and 2022, As a location, it saw an increasing number of overseas students. However, we can see in 2023 and more recently in 2024, that has significantly declined. So whilst numbers are still up marginally compared to 2018, it has been very volatile. More positively, if we look at the other end of the spectrum, we take someone like Birmingham, which is the kind of lighter orange line, and we can see that actually, as a location, that has seemingly managed to maintain its levels of growth. So if we look at the figures there, you're looking at over 10,000 additional students in 2024 compared to 2018. So it does show just the huge swings in terms of demand growth, and again, how each location is very different. Moving on to home fee students next, so domestic. Slightly different, I guess, from a trend perspective. So certainly less volatility, and actually it's more in line with historical trends. So we can see, again, taking Birmingham as a positive example here, continued demand growth from domestic students, actually quite a big uplift in 2024, which is interesting. But if you look at the figures there, under 8,000, so just over 7,000 additional domestic students in 2024 compared to 2018. And that's really following that long-term trend. Manchester, similarly, again, long-term trend is positive, and Lancaster in this case as well. And again, if we look at the other end of the spectrum, somewhere like Sheffield, over that period, it's seen about 3,500 or 3,500 reduction in domestic students. So as I say, less volatile. Domestic is really following kind of some of the longer term trends compared to some of the more recent volatile international recruitment. So let's now look at how that's impacting PBSA velocity. For anyone not familiar on the call, so we've been tracking this for a number of years now. We have about 170,000 beds now taking part each month. And what that allows us to do is understand the leasing velocity specifically for PBSA. Starting again at a national level and looking at specifically studios within PBSA to begin with. And if we look at the orange line here, that's the leasing velocity for the current letting cycle. And we can see that it is down year on year. And actually that ties in with that story of fewer international students who are not exclusively, but predominantly going to be looking for more studio type accommodation. And if we look at the numbers, we're looking at about 38% of studios being let by March, and that's obviously down compared to about 51% in the previous year. The one thing I would say here is we've obviously got multiple years plotted within the chart, but actually given, again, the post-COVID boom in demand, I probably would say actually 2023 is probably not an accurate comparison just because of how bullish the market was during that time. Looking at clusters, again, down slightly year on year, but actually less so. So leasing velocity down about 9 percentage points, and that's compared to about 13 for studios. And interestingly, it's actually tracking pretty much in line with 2022 levels. So we'll see how this plays out for the rest of the season. I know there's a lot of questions in the market at the moment around, is the market slower or is it lower? And we'll come back to that as we kind of summarize towards the end. Moving on to search behavior next and how that's developed over the last 3 months. So this is a chart we display in each of our sessions, but just updated for the most recent period. In terms of the bars on the right-hand side, just to be clear, so Q1 for us is actually referring to October to December last year. So we would classify that as Q1 of the 25-26 letting cycle. And therefore Q2 is January to March just gone. So what we can see from that data is how demand has started to shift away from those larger sizes towards the smaller units. And looking at the numbers there, if we look at the last 3 months, there's about 59% of searches, roughly speaking, we're looking for 3 beds or more. And that's down from about 83% in the previous quarter. In particular, what you'll notice is the drop off in those kind of larger sizes, so 6 beds or more. And again, in the current period, so Q2, that's about 8% of searches, and that's down from about 26% again in the previous quarter. Now, whilst that shift is obvious and we can clearly see it, it's not unexpected, and actually that's really fitting in line with the usual trends we would expect to see. And as we move into the next quarter, which we're already in, that's a trend we would expect to continue, and you'll see more and more demand for the smaller sizes, predominantly being driven by internationals, and larger sizes somewhat falling away. Obviously, for operators, that's key and very useful to know, particularly around things like marketing strategies and who you're targeting, depending on the time of the year. Something we wanted to look at next is demand, but specifically by price and specifically for two key demographics. So we've got British and Chinese in this example. Just to explain briefly what we're actually looking at here. So this is what we classify as listing views. So there are numerous ways that we can look at demand. This is just one example of this. And a listing review refers to a property that's been searched for and then clicked through by the house hunting student. So if we look at the numbers, we can see the average price point being, again, viewed either by a British student or Chinese student. And if we look at the British numbers to start with, we can see actually we're still in positive territory. So the average price being viewed is up about 2.4% year on year. Interestingly, though, Chinese numbers are actually down slightly. So again, the average price point being viewed by a Chinese student so far this year is down just over 1%. Now, there are lots of reasons for that particular data set. Is going to be a combination of demand, student budgets, the rents in the market. So all of those playing into what that figure is being recorded at. What I'd also say of the Chinese numbers in particular is we are still relatively early in the house hunting season. So as we progress through the rest of the cycle, if the market is indeed just slower, then we could expect that number to increase and improve. If it's lower, then maybe less so. So we'll keep a really close eye on that and see how it plays out for the rest of the cycle. Kind of moving gears slightly, something I wanted to touch on. We actually presented this at the recent LD conference, but I thought it's worth covering quickly again for anyone that didn't get a chance to see that, is the potential impact from the Renters' Rights Bill. We could do a whole session on this. I'm going to focus on one particular area. What this particular data set is showing on the right-hand side is the letting seasonality specifically for HMOs. So what we can see here for last year, and this is again played out pretty much every year, is a lot of demand in the run-up to Christmas, dropping away a bit and then picking up slightly again afterwards. The interesting point here is how early those HMOs are being let. So if we look at, again, the contracts going through concurrent, well over 60% in the HMO market are being signed more than 6 months in advance. Now, an interesting point from the Renters' Rights Bill is that that will no longer be allowed in the HMO market. So we're going to potentially find an interesting situation, possibly this year, depending when the bill comes in, where in, say, November, we're going to have domestic students that want to go and sign a contract in the HMO market, but can't. Now, one option for landlords is they bring forward the start date. That might not be attractive for domestic students if it's not aligned with term dates, for example, but it could potentially be interesting for PBSA. So PBSA, whilst it's not fully confirmed, the general assumption is it will be exempt, and therefore they could find themselves in a position where they are able to take that early demand, whereas in the HMO market, they may not. So there's still a lot of moving parts with regards to the Renters' Rights Bill, but I thought the seasonality piece is an interesting one. And again, we'll see how that plays out later in the year. Moving on to planning next, and specifically planning activity. So again, a chart we usually refer to in these sessions. In terms of activity, I guess, over the last 12 months, it's actually come off slightly, which is interesting. So again, over the last 12 months, there are about 40,000 beds being submitted and about 31,000 being approved. And we can see that's down slightly for both year on year. We can see there was a bit of an uptick over the last kind of 18 months, but that has seemingly come off slightly. So it looked like the market was recovering from a planning standpoint, but that has, again, started to move back down, which again is interesting to note. In terms of where those hotspots are, a lot of these locations probably won't surprise many people. But over the last 12 months, a significant proportion of the beds being submitted are being done so in really a handful of locations. And it's the big ones, which again, probably won't be new news to people, but the likes of London, Glasgow, Bristol, etc. So really the planning pipeline, again, is very much focused on relatively few locations. In terms of what's been submitted and approved over the last 3 months or so, I won't read these out one by one, they're all see on screen, but just to call out some relatively big applications, one from Vita there that sticks out in Manchester. Again, there are more than these. This is just a sample of those that have either been approved or submitted in the last 3 months or so. So what does that mean in terms of PBSA supply growth? The data on the right, it really shows the, I guess, slowdown in the number of beds being delivered over time. So in 2023, there was about 12,000 new beds being delivered, and we can see that's down significantly compared to, say, 2019. And that really follows on from the previous charts that we just saw with regard to planning activity, which again started to decline. This year, it's still early days, but it actually looks like numbers might be up slightly, but we are still very much below the kind of historical average, and again, very much below the figures reported in 2019. As always, though, that's from a national standpoint. And actually, if we look at the pipeline and compare that to the existing level of supply in a number of locations, again, there's a lot more that we cover, but just to call out some extremes, what it means is that pipeline is very much uneven, and therefore the growth potential per location, again, is very much not evenly distributed. So we can see in somewhere like Glasgow or Bristol, there's the potential for significant PBSA supply growth from a percentage standpoint, well over 60%, for example. However, I would caveat that it's very, very unlikely that all of those beds will be delivered, obviously. And actually, when we've looked at those stats historically, in some locations, it's well under 40% of beds being submitted actually come through to completion. So again, we'd expect those growth numbers to actually be a lot lower. But then at the other end of the scale, we've got some interesting markets that are potentially been challenging, I guess, over the last few years. So Coventry and Sheffield are two that stick out. They actually have very limited supply pipeline. So interesting there, could those markets be potential long-term targets? Maybe, but that's going to very much depend on an individual's expectation around future demand growth. So I guess to summarize very quickly before I hand over to Alex. So again, demand growth has been very volatile in recent years, and that has made it challenging to predict fundamentals. And we've kind of seen how those have shifted slightly, still remaining positive, but probably less positive than in some of the previous years. As I mentioned, PBSA leasing velocity is down. So really, we're going to keep a very close eye on that. Anecdotally, we have heard it has improved in recent months. So we'll see if that's reflected in the latest data when we receive that. As I said, planning, we did start to see a recovery, but that is starting to slow again, which would be positive for existing operators or investors in the market. But again, fewer applications being submitted. But it does also mean that PBSA supply growth is very much not evenly distributed. And that means that supply and demand, again, as we've said in previous sessions, is very different per location. Going back to the first point regarding demand growth and the difficulties around predicting it, we were actually joking before we started that Trump has just announced new measures, again, just today, a few hours ago, around revoking Chinese visas. So it shows how difficult it is to predict the market, and hopefully those will be positive tailwinds for the UK at least. For anyone that wants obviously more information, feel free to reach out. We do have our data platform. So again, anybody interested in seeing that, you can scan the QR code or reach out separately. And obviously more than happy to run through that with people. That's it from me today. So what I will do is I will hand over to Alex, and then we'll go through hopefully some Q&As towards the end.
Thanks, Richard. Hi again, everybody. Just wanted to give a quick overview, I guess, of what I'll be covering. First is kind of as Landmark, who are we? What do we hope to achieve in the European market? And then also, what are some things that we're thinking about? Most of what we're thinking about is honestly a lot of Richard's data, but some of the kind of macro context around those figures are the conversations that we're having pretty frequently as well. So I guess starting with the Landmark overview, we are the largest student housing developer in the US. We were founded in 2004 on a pretty simple principle, actually, that there was an opportunity to improve the lives of students by offering purpose-built housing in a more comfortable fashion than what was typically on offer in the HMO market. Over that time, over the last 20 years, we've grown pretty substantially. We now manage 74,000 beds across the US, have invested in over 150 projects, and have about 15 billion in AUM today, leading to about 1,500 employees across the country. What the key characteristics, I guess, we would describe of Landmark are all based on our central tenet, which is basically one investment principle, and that's that we want to control as much of the risk as possible in the development cycle. So the first and best example of that is probably in our vertical integration. Landmark is in the US, we are both a developer, a property manager, investment manager, and a in-house general contractor. So we're actually the largest student housing contractor in the US in addition to developer, which really helps us control every aspect of the investment process and just get that tighter risk control. The next thing is sector expertise and experience. We've been in student housing for over 20 years now. We've learned a lot of lessons, some the painful way, and have really refined our investment processes and approach to risk as a result of each of those opportunities. The next thing that we look to do to diversify risk is product segmentation. In the US, we operate in 54 markets, and we actually have 9 different brands that we use across those markets, some tailored towards certain types of product, others might be high-end, some might be affordable. We like to diversify that leasing risk that way. And then lastly, one of the characteristics, I guess, of our business today is that we're able to use our balance sheet that we've built up over the last 20 years to access opportunities that some others might not be able to unlock just by virtue of either complexity or the investment required prior to construction start. Where that leads us to today is, our international expansion. So we have actually been tracking the UK market since 2019. That was actually the first time that it came across our radar in the US that, hey, during the first Trump presidency, international enrollment started to decline, and we started seeing a slight impact, I guess, of that across our US portfolio, and started thinking, hey, where are those students going? The obvious and first choice for most of those students ended up being to the UK. And so we started tracking this market in particular very, very closely. Of course, then we were delayed a couple of years with COVID, and then a series of macro shocks between wars and inflation and a lot of ongoing issues that still obviously impact the market today. But ultimately, we decided that now is the right time for us to enter the UK market for basically 3 reasons. The first of these is that there counterintuitively are new barriers to entry that have made it an interesting time for developers to try to get in the trenches, find the best land sites, and see if there are new opportunities there. Things like the Building Safety Act and other regulatory changes have just made development more difficult, which we think is only going to choke off supply further. You saw in the graph that Richard projected earlier in the presentation of basically deliveries have been declining from 2019. We think that that trend will continue and that will be below the 10-year average through 2027 at least. And therefore, there's an interesting opportunity for developers today to kind of, I guess, work through those new barriers to entry, but ultimately benefit from long-term tailwinds. The next thing is increased yield environment. As interest rates increased and yields expanded, we think that values are depressed today. Yields today are probably 75 basis points plus wider than peak, and we think that as interest rates continue to decline over the next few years, there should be some return to normalcy of those yields, though we would never underwrite back to peak or anything like that. And then the last bit is what we view as basically the start of a cycle. Again, I guess looking at that graph of deliveries being down and new barriers to entry, and at the same time tailwinds of large rent growth over the last handful of years, we think that this is signaling the start of a new development cycle where new supply is constrained, and we will get to benefit from tailwinds of rental growth over the medium term, probably. Maybe not at the peak levels of the last 3 to 4 years as a result of broader inflation, but just simply because supply is going to be choked off, and there should be an opportunity for those who get to play in the market. So ultimately, last year we launched. We now have 8 people in the UK, also supported by, of course, the big team back in the US. We initially are going to be targeting just UK opportunities, primarily spending our time focusing on development, but we are also selectively looking at operational acquisitions where we think that there's a perceived kind of value discount versus where some of these portfolios should be trading at historic norms. Ultimately, we still think that the UK is the second most institutional and mature PBSA market in the world, and offers great risk-adjusted returns with the same resilience that everyone kind of commends the PBSA industry for. And then lastly, a few things that we're discussing internally, we categorize it broadly as risks and opportunities. From a risk perspective, macro environment, geopolitics, it's very difficult to keep up with those things today, as was mentioned earlier in the presentation already. US policy is changing on a daily basis. This week, there have been updates to tariff policy. There have been updates to US student visa policy. All of those things will have an impact on the UK as well, but those things are a bit out of our control and hard to predict. From a regulatory policy perspective, Building Safety Act, of course, is top of mind for everybody. We're trying to figure out how do we manage the risks of that process earlier in the development cycle. Other things like the Renters' Rights Bill, rent regulations being proposed in Scotland, all of these things are kind of impacting how we are viewing risks in the UK market. And frankly, the regulatory, macro, geopolitical risks are ones that we unfortunately can't control. And that's actually causing us to have tighter parameters around the risks that we can control. So we're being more selective probably about site locations, about markets, and layering in additional conservatism probably into our underwrites today versus what we would have done in the market, say, 5 years ago. Lastly, I guess to end on a high note, we do still think that there are a lot of opportunities in the market today. Prime development seems to be a unique opportunity today in that PBSA, maybe for the first time in UK real estate history, is one of the highest and best uses of land. It's one of the highest values per square foot, and therefore we are able to, and what that's kind of resulting in is developers are able to find sites that they otherwise wouldn't have had access to. And we think sites that are much more prime, let's say, than were available in the prior development cycle, which will ultimately be the competitive set for the new stuff that's being delivered over the next few years. So for us, that's a really exciting opportunity. Further discounted pricing, I've already kind of touched on that with wider yields and some potential opportunities on the operational kit to acquire portfolios at basically the same basis as you could have a few years ago prior to what has been 20% rent growth in some of these portfolios. Next, debt availability. We really like the debt market in UK PBSA. We actually think that it's more mature than in the US. There today seem to be more lenders in UK PBSA than ever before, and every process that you run on the debt side is extremely competitive and compelling, even if true interest rates, I guess, are higher than they used to be. And ultimately, what that's leading us to believe is that there's still pretty good risk-adjusted value in UK PBSA. We know that it's more mature than some of the Western European markets that someday we would like to focus on. But what we view as the positive of that is that you kind of get to understand the risk and know what's going to be the outcome down the road versus some of the more nascent markets. All in all, we're here, we hope, for the long term, and we want to be very active in the coming years to help some of that supply-demand imbalance.
Perfect. Thanks, Alex. I think it's really good to get your kind of US perspective on that as well, and kind of what you're seeing out there. What I'll do is I'll just take you back of control of the slides. So for anyone obviously that wants to get more information, particularly on a monthly basis, do feel free to reach out and obviously sign up to our newsletter. I think we've probably got a bit of time to go through some Q&A, so I'll hand back to Danny, and I'll stop sharing my screen. We can hopefully pick up some of those questions.
Great. Thanks, Rich. And thanks, Alex, for your insights. It's really good. And I think we'll just dive a little bit more deeper into the Q&As as well, just to get your thoughts. Before we do that, I think, Rich, if you can just pull up the poll answers and we can just run through what everyone's kind of feelings are.
Yeah, I'm actually not sure whether it worked or not, so I think we'll come back to the poll and
Oh, fine. Great. Okay. So I think first question for you, Alex, is pretty much around, of course, US tariffs and immigration. So do you think that the current US posturing on tariffs and immigration will have a positive impact on overseas student numbers in the UK?
I think that's a really top of mind question for everybody in the industry. And we actually look at it as two separate questions, one about visa policy and then the other about tariffs, which sometimes I guess those things are a little conflated in the broader Trump, Trumpism. The starting with, I guess, the U.S. student visa policy. Overall, what we think about that is that it's going to have a very negative effect on the number of international students attending university in the U.S. There's no way to get around some of the policies that they've been proposing as recently as this week, as recently as within the last few hours. These things are getting more and more restrictive around Chinese students, around all foreign students being banned from visa application interviews at the most critical time in the application cycle. All those things are just going to lead to a downfall in international students visiting the US. What the impact is to the UK then is we think that many of those students will look to alternative opportunities to study in English-speaking universities, which primarily are in the UK, Australia, and Canada. Australia and Canada have both recently implemented more restrictive policy as well. And though the UK has not necessarily had friendly rhetoric towards international students, it certainly pales in comparison to anything that the other big three English-speaking university markets are exhibiting. So all in all, we think that there's likely to be a positive impact to the UK market from US decline. And I guess just to give some context of how big that impact could be, we think that, if there's a 20% decline in US international enrollments, which we think is very much on the table, and if the UK is even able to capture just 1/3 of that, that ends up being roughly 75 to 80,000 students. And 75 to 80,000 students suddenly captured in the UK market would be more than the number of beds that have been built in all of PBSA since 2019 combined. So the potential impact on the demand side could be massive, but we of course expect something more measured than that. Jumping over to the tariffs really quickly as well. In the US, because we're a contractor, that was something that we analyzed very deeply, let's say. I would say that the kind of overarching takeaway from our analysis there was that actually in the US, on average, about 22% of our hard costs were exposed to tariffs, which you then have to apply a potential tariff rate to. That is anybody's guess, given how quickly the rates and reciprocal rates and everything have been changing. So you have to apply assumption to that, and then you also have to apply it to the specific project that you're looking at in terms of what percentage of that project is made up of hard costs. Ultimately, what the average impact is on the 40 or 50 projects that we have in our US pipeline today, it's been about 1.5% to 2% of total development cost increase that we're projecting in the US as a result of tariffs. They may sound like a relatively small figure, but it certainly has an impact on underwrites. And it's something that we're basically just having to factor in and see, hey, is this project still going to be viable in spite of these increases? The segue from that then to the UK, or really the rest of the world, is really a question of then how much spillover is there from US tariff policy into pricing around the world. will just the US absorb the, price increases, or will potential suppliers and sellers to the US look to push up prices in the UK, for example, so that they don't have to push up prices in the US as far, and so that it's more of a blend and it's spread. Ultimately, what we think is that there's going to be a more muted response or more muted impact in the UK on tariffs than there is in the US, which again we view as probably 1.5% to 2% of total development cost. And we're basically underwriting that already with an additional 1% to 2% of contingency in all of our budgets.
Great, thank you. Thanks, Alex. The next question is just around understanding like the market this year. I think it's really clear in many locations that there is a delay. And as Rich, you've also reported that there are delays in certain locations. But does the evidence suggest this is merely a delay, or do you feel that voids in tough markets could in fact increase this year?
So yeah, I mean, not to sit on the fence, but I think it will very much depend. I think there are going to be some markets where it probably will be down year on year, and I won't go into all the detail now. Again, we've covered these in previous sessions, but you look at the supply growth in some markets, it has been significant in the last kind of 2 to 3 years, and that's not being matched by demand growth. So in those markets, I would not be surprised for it to be down. There are other markets where it probably is just later, and anecdotally, I'm speaking to various operators, we have heard, again, it's anecdotes, so it's hard to quantify the actual impact of students outright telling the operator, we're just waiting. And part of the reason for that, particularly last year, where we saw more incentives being kind of rolled out of in the market, which again, we didn't really see post-COVID just because how strong demand was. There is that kind of element of chicken and egg essentially, and students waiting for those incentives to become live and then book. So it does seem like there's a bit of a waiting game. But again, it's very difficult to quantify that. But through our occupancy data, we can see the markets which are well ahead of others. But yeah, the end position at this stage is quite hard to predict.
So there's another question around HMOs. So we still seem to have a lot of student HMOs left on the market compared to previous years. Is there a reason for this, and what's the demand for student HMOs?
So yeah, it's a fair point, and actually there are markets. I think Durham's one last year actually, where we did see more properties being left or available to let later in the cycle than we have done in previous years. I think going back to the point around recruitment volatility, certainly again referring back to COVID, but there were certain universities that saw huge recruitment coming out of COVID. Some of that was internationals because they were essentially scooping up a greater proportion of international demand. What we saw post that was, again, some universities almost changing their cohort mix. So, for example, maybe they're now more exposed to internationals. They are obviously higher fee paying, so that's probably a financial incentive to do that. So therefore, whilst the total number of students might be increasing or could be even flat, and in some cases down, the makeup has shifted. So again, that could be positive for PBSA, it could be negative for PBSA, it could be positive for HMO, negative for HMO. It really depends on the specific university and location that's being referred to. What we do see, though, also in some of the conversations we have, particularly on the HMO operator side, is sometimes there's a lack of awareness of how the market is changing their location. So a prime example of that, if you're in a market where demand is declining, are you aware of that? And it sounds very obvious, but not everybody is, because not everybody's tracking this stuff on a day-to-day basis. So again, if you're a HMO operator in a market where undergraduate domestic demand is declining, naturally that's going to mean there's going to be likely more HMOs left later in the cycle. So yeah, it will very much depend on the detail, as I say, which location, which university, what product, all that kind of comes into play.
I think just keeping on the HMO trajectory here quickly, another question had come through in the Q&As about just potentially, Rich, maybe if you can just explain the rationale for why the renters' rights would require HMO tenancies to be brought forward.
Yeah, so I'll caveat this by saying definitely go and seek expert legal advice. I'm not obviously an expert in tenancy law. However, from my understanding, as part of the bill, HMOs won't be able to let those properties more than 6 months in advance. So the chart that's probably been referred to, which I showed previously, was looking at the seasonality of when students are signing their HMO contracts. The vast majority doing that again in the run up to Christmas and some after. But what it means, if you look at the start date of those contracts being signed, they are typically starting 6 months out. So if you're signing a contract in November, the actual tenancy start date might not be till July, but that's more than 6 months. That won't be allowed once the bill comes in. So therefore, how does the market react to that? Do we see the tenancy start dates come forward to enable a tenant to sign in November? Potentially, but again, the point I was making there is that domestic students might not want that if it's not aligned to term dates. So we don't quite know how this is going to play out yet. And actually, going back to what Alex mentioned earlier, there are lots of moving parts. So whether that's US policy or recent graduate visa routes in the UK or renters' rights bill, there's a lot of moving parts. So trying to work out what the net impact, once you've taken all of that into account, is quite difficult naturally, and obviously can change day to day depending on what's going on in the US in particular. So yeah, hopefully that's explained the point, but again, I would definitely go and seek expert advice. A lot of this stuff's still not entirely certain as well. So again, around PBSA exemption, the broad assumption is it will be, but I don't think it's technically being confirmed yet. So yeah, it's one that I would urge people to definitely get up to speed on.
Thanks. Just on to the next question, just of time. Have the number of student accommodation inquiries increased or decreased in the Canterbury market specifically?
Yes, it's actually an interesting one. So the issue, particularly with somewhere like Canterbury, and there has been a number of stories around this, and this is going to also be relevant to anyone looking at investment, is one of the challenges for the whole sector is around quality of data. And Canterbury in particular, and there are some other locations, there was a lot of growth in what they classify as, I think it's franchise courses. So whilst the overall numbers look like they are increasing from a student, total student perspective, it's not necessarily correct if those students are going on to franchise courses, which may not be in those particular locations. The problem is there's basically no data to determine which of those students it actually applies to or not. So it comes back to what we've discussed in other sessions around there are some data sets within the market where the quality quite simply is not good enough. Obviously, we're doing what we can to improve the quality of data, but particularly when it comes to something like HESA, the industry is very much reliant on that to understand student numbers. Obviously, it's massively out of date. There are lots of caveats around things like term time accommodation stats, which they produce, and also around this concept of university franchising. So it's hard to say. I wouldn't want to go into specific details of are we seeing demand increase in Canterbury or not, but I guess going back to that point, looking at student numbers, it's not clear cut because the quality of data is not there. And that makes it very difficult to then also predict certain markets. And Canterbury is probably one of those, just because of that, again, lack of quality data, really.
Great. The next question is quite a long one, so bear with. But with many local authorities starting to dictate mixed-through policy, are you seeing a shift in the market delivery to suit, and how is this affecting rental levels? And then part of the question is planning-wise, it helps the HMO benefit justification have more cluster or social studios as opposed to the individual studios to replicate the shared house. But we know this affects viability or appraisals.
Yeah. So what would actually be interesting to I mean, possibly a future session is actually get some local authorities to give their view. My general assumption is that local authorities are pushing more clusters over studios because there's an assumption they are cheaper than studios. Whether that's the case or not, it will depend on the individual markets that the developments being proposed in. But I think that's probably one of those driving factors. However, it would be great to hear directly from the local authorities as to why they're doing that. Yeah, that does obviously create challenges around trying to make a development viable if you're having to build more clusters or studios or vice versa. Equally, we have seen in some cases some applications trying to get around that. So there's some developments that we've seen, for example, that are studio led but they are sharing a common kitchen area in addition to the studio unit. So they're technically classifying them as cluster studios. So there may be ways around that particular piece of legislation, depending on the local authority. But yeah, I mean, in reality, if they want more accommodation to be built in their markets, they need to probably have fewer barriers to entry. But obviously, they're potentially going the other way in some councils.
Great, thanks, Rich. There's still a couple of questions, but just conscious of time, and I'm not sure if you've got the poll to work, if we're going to run through those answers. But we can jump on a couple more questions or...
Yeah, I think with the poll, we'll have a look and we'll post it as part of a follow-up piece if we can.
Perfect. Cool. Then I think I'm gonna just have a look at the Q&As and just see if we have potentially just one more question. I am gonna, so the most recent one, the UK pipeline looks to be made up of a large proportion of studios. Is this a particular risk to owners of studios, heavy schemes, or is this a normal trend versus history?
It's a good question. I think again, it will depend on the specific location, which sounds like a bit of a cop out, but it is generally the case. Obviously, there could be a market that has for argument's sake, a disproportionate proportion of studios being proposed in the pipeline. But if there are relatively few existing in that location, it may not be an issue as such. Whereas certainly there'll be other markets where it's the opposite of that. So as always, it will very much depend on the location or even intracity location. Naturally, if you are building a studio-led development and it's sitting next door to an existing studio-led development, that's obviously an important consideration. And that's something that we obviously track as well. So I think in terms of trends, we have seen over time a general trend towards a greater proportion of studios per development. But again, that's going to come back to viability. The assumption you can charge higher rents for studios, therefore it makes the development stack up. So yeah, it's one we'll keep an eye on. I would expect that trend not to go away, to be perfectly honest, due to construction costs and again viability challenges. But yeah, we will certainly keep a close eye on it. I don't know, Alex, whether you've got any opinions around studios and cluster-led developments. You have any particular preferences there? Be interesting to maybe get your perspective.
Yeah, there are kind of two sides to it. First is, I guess, just generally in the US, we really believe in product segmentation. We want to have a diversity of options offering to different affordability levels, different amenity levels, all across the board. But then there's also the question of viability. The reality is that today in the UK PBSA development space, studios seem to be the most viable. And so I think a lot of developers are probably trying to stick as many of those into their projects as they can. And perhaps some of what we're seeing with some of the councils is pushback to that approach, suggesting that, hey, we need diversity of affordable options here, and we need to go the other way with policy. But there are going to be challenges with getting those numbers to stack up.
Yep, agree.
Great. I have one more question, which I think could be quite interesting. Again, it's a bit of back to the HMO and Renters' Rights Bill, which, Rich, we are aware you are not a lawyer, but I think it's quite an interesting one. With the changes in the Renters' Rights Bill being so disruptive to the HMO market and potentially not for PBSA, do we think that there could be more of a plan that is to persuade more landlords to sell up and end up funneling more students towards PBSAs? And do we think we're less likely to have single HMO investors and it will be more LLS with large portfolios?
Yeah. Again, it will depend on who you speak to. So there are what I classify as institutional HMO investors we do work with, and they don't necessarily see the Renters' Rights Bill as negative for them. I think the way that it can be viewed is that, going back to something that Alex said at the start, more regulation actually is probably a positive for existing operators. It creates higher barriers of entry, and therefore that's going to be supportive of existing stock. I think on the point specifically around will we see some HMOs leave the market? I think yes. Again, it's going to be difficult to quantify that. One of the challenges, again, around the data within the sector it's one thing a HMO property being sold, or is it just changing hands? And obviously that's the difficult part to determine. Is it actually stock leaving, or is it just simply being absorbed by a larger institutional investor, which some of it will be. I think the reality, though, the renters' rights bill generally, from a domestic standpoint, it's obviously not inducive of more stock. And if UK demand keeps growing and all the kind of macro suggestions indicate it will do, then it's highly likely that rents in the HMO market are going to go up. Now, then the question is, does the PBSA market start to look more attractive to domestic? Again, it will vary per location. There are some markets in the UK where the average PBSA price is not too dissimilar to HMOs. So in those markets, you may well see more domestic students moving across just because of price point. Whereas there'll be other markets where the spread is so large that actually it puts domestic students in a potentially difficult position where they can't easily find HMOs because of the stock, or the HMO rents have gone up. They also can't afford PBSA. So we'll see how it plays out. I think, yeah, it's probably going to be, again, going back to what I mentioned earlier, what's the net impact? I think the net impact short term is going to be a bit of a mess, to be perfectly honest, for both PBSA and HMO. The long term for PBSA could potentially be positive. But again, we're kind of guessing at this stage until we've got a bit more clarity over the exact final bill and probably how that plays out over the next 12 months, really.
Alex, I don't know if you've got any additional thoughts to just add to that one.
Not in particular. We are also concerned about the renters' rights bill and what the potential impact could be. I don't think that we have as much concern as what we've heard previously from the StuRents folks, that it could potentially price some students out of university altogether, and that could potentially hurt some of the demand profile of certain of the markets. But that one has been, the legislation on that one is so nuanced and so kind of floating around that we don't have a strong perspective on it's going to push demand or decrease demand yet. We're kind of assuming things stay relatively flat.
Yeah, I think that the other point there as well is that it's all based on the assumption that students are even tracking this stuff. So actually, there are general awareness within the student body that even know about the bill, and I'd probably argue there's going to be a huge portion that don't. So again, trying to understand what that net impact is going to be is really difficult. And over the next kind of 12 months, once it comes in, we'll hopefully get a clearer picture.
Thanks, guys. I think we'll kind of close off there. There are still loads of questions, but we will probably get to those in our post webinar blog that we usually do, a little roundup of questions. So if your questions weren't answered, just keep a lookout for that blog and Content Hub, and I'm sure we'll share it in the newsletter as well. Just as a final reminder to everyone still on the call, this recording, the session is recorded, so we will be sharing this with you post the webinar. And just a reminder to follow us on LinkedIn, StuRents, and also just sign up to our monthly newsletter to access trends and insights from our intelligence team. So that leads me to say a big thank you to Rich and Alex for sharing your insights and for all of your comments and insights. So thank you so much, and thank you to everyone. We hope to see you again soon, and enjoy the rest of your afternoon. Thanks.
Thanks, everybody. Cheers, Alex.
Thank you, everyone.